This video will help you understand what it means to be over-diversified as it pertains to your wealth accumulation and how you can avoid this from happening. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. Now, it's oftentimes preached by advisors to be well diversified in their investment portfolios. And philosophically, this applies to everything on your balance sheet. For the same level of expected output, if you can achieve those same levels while taking on less risk through diversification, well then by definition, that's a more efficient and safer method of building wealth long term. That being said, it is possible to become too diversified, whereby for every additional level of diversification you layer into a portfolio, you don't actually maintain that same level of return and or other risks crop up. So in today's video, we'll cover some best practices as it pertains to building wealth in a diversified fashion without becoming too diversified. So let's jump in. Now, if you're the type of investor that likes to put all of their eggs into one basket, that's generally a losing strategy, even though anecdotally it does work out for some people. For everybody else though, let's talk about some best practices relative to diversification. Over the past few decades though, I've definitely seen a pendulum swing back and forth between severe diversification and concentration. Coincidentally, they always tend to revolve around some level of market recession or market boom and bust. In 2008, oh, we should have all been way more diversified. We were way too concentrated. Most recently, hey, just put it all in the S&P 500. You'll be totally fine. The S&P 500 always goes up. Quickly to define our terms, under-diversified, diversified, and then over-diversified are not regulated terms. There's no clear definition as to what any of those mean. For example, what one investor sees as a very diversified portfolio of technology stocks, another investor might find to be way too concentrated, namely in technology stocks. A too concentrated approach means an investor feels that they have too many eggs in too few baskets, whereas a well-diversified approach means an investor feels like they have the right amount of eggs spread out between the right amount of baskets. There's no dogmatic definition behind these terms. In addition, one's level of diversification is not limited to their investment portfolio. Presumably, there's other assets on the balance sheet that overall encompass somebody's net worth. Those also need to be diversified, or at least philosophically, the balance sheet should be diversified. For example, let's say someone that owns a business running various properties also has an investment portfolio they run on the side. Sure, in a perfect world, their portfolio would have diversification amongst all sorts of different market segments, but they probably don't also need to diversify their portfolio into real estate securities because they've got enough of their balance sheet tied to the real estate space. Likewise, a technology executive who uses their bonus every year based on performance of the company to pay for their kids' college tuitions probably shouldn't also have a great deal of company stock and or at least a tremendous amount of their portfolio diversified into the technology space. Namely because if the technology space takes a dump, their portfolio takes a dump, their bonus takes a dump, their ability to fiscally support their kids takes a dump. That wasn't a very diversified approach. For the purposes of this video, I'm going to use the term diversified versus not diversified, relating it to various market segments, which a lot of times people would just think of various indexes. This is the more academic approach to diversification within an investment portfolio, whereby you break up your level of diversification or non-diversification between various market segments like US large cap, think S&P 500, US small and mid cap, think Russell 2500 index fund. International exposure, think MSCI EFA. And then lastly, maybe bond exposure. And for that, you could use the Bloomberg Aggregate Bond Index as an approximation of that space. There's other market segments, and I'm going to link below to what's called a Callan table that breaks down the performance of each one of these market segments over the past decade. And after doing this whole financial planning thing for a little over a decade, I've seen this Callan table shift over time, which personally just reaffirms the value of being diversified. We never know which market segment is going to be on top. It usually changes. Now let's transition to how you could end up with an over-diversified portfolio. I'm going to define an over-diversified portfolio as one whereby additional increments of risk mitigating investments actually further exacerbates one's risk and or can limit the returns of said portfolio. Now that's a pretty technical definition. I guess another way to say it is when doing more results in less. Let's go through an example to kind of demonstrate my point. Let's say you have an investment portfolio that's broken up between two investments. Let's say it's got 80% in the S&P 500 and 20% in some US bond index fund. Now, I wouldn't argue that's the most diversified portfolio in the world. I guess technically there's more exposure than just one security, so it is diversified. Let's say you want to diversify further by further breaking up the stock-oriented section of your portfolio into also adding some small and mid-cap exposure. Let's also add in some international exposure as well. And just by looking at the portfolio now, it's far more diversified amongst various international market segments, but it's not crazy complicated with just 4 securities. That being said, it's definitely more complicated than it was before. Now let's say you further divide up the portfolio in an attempt to become more diversified. Let's add some index funds that track the top 100 companies of the NASDAQ. Let's also add some various bond funds, maybe a corporate bond fund and a municipal bond fund specifically. I guess at this point, we don't have anything that's really focused on the health sector. So let's add some healthcare focused mutual funds as well. And while we do have a good amount of exposure in bonds, I did hear recently about these securities called fallen angels, which were investment grade bonds that have recently been downgraded to junk bonds. Junk bonds kind of perform like stocks, so we'll add that into both types of segments of our portfolio. Oh, also, NVIDIA has been pretty cool over the past year or two, so we'll add some NVIDIA stock in there as well. So now, as you can see, we have a much more diversified investment portfolio, but it is horrendously complicated. Personally, in all my years of doing this, I have never seen a super diversified investment portfolio that's being run by a DIY investor. I've never seen this executed successfully. Generally, a very well diversified portfolio run by a DIY investor goes unmanaged because it's too complicated to deal with, or the DIY investor will just put all their eggs into one particular security and hope and pray it all works out. It is totally possible, though, to be a DIY investor and have an institutional grade diversified portfolio. It's just going to require a lot of time and software to do successfully, but it is totally doable. Alternatively, this level of complexity can be managed successfully at far greater scale through the use of dedicated advisory teams that have access to proprietary software that spend all day managing these types of portfolios. And let's just say the level of diversification that can be managed successfully at scale has definitely increased over the decades. That being said, as you can kind of see where I'm going here, the optimal portfolio, which is not this, but the optimal portfolio can be successfully managed by a DIY investor and financial advisors and their teams. The definition of optimal, however, is going to be dictated based on what their capabilities are. If you don't have 20 hours a week to dedicate to managing your portfolio, well then a crazy super diversified portfolio will probably be defined for you as an over-diversified portfolio. Whereas if you have a team of advisors that manage a particular portfolio for you, then you could probably get away with way more diversification without labeling it as over-diversified. These types of problems get further exacerbated when one is using diversification within a non-retirement investment portfolio. And that's because of capital gains and income taxes. Now, if you don't have any income at all, then odds are capital gains and income taxes from your non-qualified portfolio is not going to be the worst case in the world. And non-qualified portfolio refers to things like joint investment accounts, individual investment accounts, UTMAs for kids, those types of things. Basically anything that's not a retirement account. This is because you not only have to worry about all the other things I mentioned of managing a portfolio successfully, which is first principles of investing, but secondary principles of investing as it pertains to taxable investment accounts is to be cognizant of the amount of taxes you're generating. And that's because a non-qualified portfolio that pays very little in capital gains taxes each year compared to a non-qualified portfolio that pays a lot of capital gains taxes each year, by definition, the one that pays less in tax results in a much higher dollar balance in the future. If a well-diversified portfolio in the retirement account space was already becoming a little bit too much to handle, that problem gets further exacerbated in a non-qualified portfolio because you can't just simply trade willy-nilly in that portfolio and expect the results to be phenomenal after taxes. You have to be mindful of things like short-term, long-term capital gains taxes In addition, you have to be mindful of dividends, because various types of securities pay various types of dividends, and as opposed to retirement accounts, any dividends that come through from a non-qualified investment portfolio are either going to be taxed at preferential long-term capital gains rates or not preferential income tax rates. It depends on the type of dividend. That just means you have to spend a little bit more time screening the particular securities that you allow into your taxable investment account. So what is the end-all be-all solution? Well, every Reddit forum and every advisor is going to have a particular pie chart of investments that they think is the greatest thing since sliced bread. In reality, the best investment portfolio for you is analogous to the perfect exercise regimen. Whatever exercise routine you are going to stick to consistently through thick and thin, that you can manage whether your schedule's busy or not busy, but you'll consistently show up to execute, that is the best investment portfolio for you. If that's one security, well, it pains me to say it, but that might be the right move. If it's a lot of different securities because you've outsourced a lot of this work to a financial advisory team, well, then that's the best move for you as well. AKA, if it's best for you to hire a personal trainer, given their specialized knowledge, accountability, whatever, then that might be the right move for you. The bottom line is, the more diversified, the not necessarily better. To give you an example of the models that my office is currently running in our all equity-oriented portfolio, I think there's like 11 or 12 securities, of course, subject to change, but generally around there. And then the more conservative portfolios have more diversification, but only by a couple more securities as you kind of cascade down the safety levels. And that's ultimately because in an all equities portfolio, for example, you're not going to have any bond exposure, so all the bond securities are not applicable. So from a calls to action standpoint, I would highly recommend you audit your current portfolio, how it's invested, and ensure it's something that you are capable of managing successfully. Nobody's going to look at your portfolio except for you, so only you will be able to tell if you've accumulated a well-diversified, thoroughly polished Ferrari of an investment portfolio, or if you've Frankensteined some conglomeration of recommendations of buddies and internet forums and whatever, and really it's gone neglected for the past year or two, and you have no idea whether or not it's a successful portfolio long term. Probably would highly recommend some changes at that point. And I'm a huge fan of simplification. Generally, when you're first getting started, the simpler the portfolio, the better. Does that necessarily mean the simpler, the more optimal? Yes and no, but generally a hugely Frankenstein model of a portfolio is probably not a winning strategy. That being said, while you are more than welcome and encouraged to share kind of why you run the portfolio you run and include all your ticker symbols in the comments, please don't ask me to audit those portfolios via YouTube comments. I'm pretty sure that's a violation of some SEC rule, and I really have no interest in going to financial advisor jail for typing ticker symbols into YouTube comments, being seen as a fiduciary level recommendation. Either way, have an awesome rest of your day, and we'll talk to you all later. Bye.